All right, good morning, ladies and gentlemen. Hope everybody can hear me out there. All right, well, we are here today to jump into the minds of two SaaS CEO veterans, and we will benefit from both their experiences as people who have built SaaS companies, raised money for SaaS companies, and invested in SaaS companies. As most of you here today are acutely aware, running and growing a business is hard. As a business leader, there's a lot of white noise and short-term crises in the form of uncooperative technology and data, HR and organizational issues, compliance and legal challenges, not to mention customers to listen to and their needs to be attended to. For many here today, the goal is to overcome these obstacles and grow your business from where it is today to a larger, more advanced and evolved version tomorrow. To accomplish this, many will turn to the help of outside capital investment to fuel critical hires, customer acquisition, commercial leases, and a never-ending list of capital requirements to sustain that desired growth. However, courting investment is far from easy. In fact, fewer than 1% of startups go on to secure venture capital funding. So, you may be wondering, how can I elevate my business above the noise of running it, as well as above the other 99% of ventures that will not go on to raise funding? Additionally, you may be asking, what data sources should I be connected to use and guide in my decisions? Well, if so, you are in the right place, and we are here to help. Today, with the help of CEOs from both Lighter Capital and Grow, we will cover what metrics and KPIs you should be in tune with, not only to court investment and give your business the upper hand in negotiations with investors, but also, and relatedly, the key metrics you should be focused on as a manager of your business to give it the best chance to become the business that you envision. So, a few housekeeping items. If you have any questions, please submit your questions, and if there's any concerns or issues, into the chat box, if there's anything with audio or visual. Additionally, if you have any specific questions that aren't addressed, or you would like to dive deeper into some of the topics that are addressed, please enter your questions in the chat box. We will be sure to leave plenty of time for questions and answers at the end, and we will do our best to get to all of your questions. So, we have two amazing panelists with you today who are not only leaders of growing venture-backed businesses, but also have a unique perspective on why metrics and data are so critical to a business's success, specifically as it relates to fundraising. Our first panelist is Rob Nelson, the CEO of Grow. Rob got a start in business in college when he first bought his first company. He bootstrapped Logica for over 10 years until it was acquired in 2012. His experiences inspired the idea for Grow, a sleek, customizable dashboard that merges data from multiple sources in real time. As CEO, Rob has led Grow to 37% month-over-month revenue growth and $12.5 million in funding. And our second panelist is BJ Lackland from Lighter Capital. BJ is the CEO of Lighter Capital and spent his career working with emerging technology companies as an operating executive and investor. Before he joined Lighter Capital, he was a consultant to early-stage technology companies, an angel investor with Element 8, and the CFO of Power Efficiency Corporation. Earlier in his career, BJ spent 5 years as the vice president and director of Summit Energy Ventures, a VC firm focused on investments in energy technology. Now, to introduce the companies which each of these gentlemen represent, I figure there's no better person than the gentlemen themselves. So, BJ, please introduce us to Lighter Capital.
Thanks, Tom. It's a pleasure to be with everybody today. So, Lighter Capital is a tech-enabled funder of early-stage startups, primarily SaaS. About 70% of the companies that we fund are SaaS or SaaS and services type businesses. And we use a lot of technology to do this and to bring in a lot of the metrics that we're going to be talking about today and to do the analysis on these companies. Overall, we're funding about 8 to 20 companies a month. All total, we funded about 300 financings to about 180 companies. We do it with a loan product called a revenue-based lending, where it kind of aligns the interests of the entrepreneur with the interests of us, the capital provider, because it's essentially a royalty agreement. So it's non-dilutive financing for the entrepreneur, but because it's a royalty, it really aligns us and the entrepreneur together towards helping to grow the business. So we love to do things like this where we can help educate the broader tech community and SaaS companies in general, because we feel like we get to learn a lot about them and get a lot of their data when we're funding them.
Excellent. Thank you, BJ. And now, Rob, could you let us know a little bit about Grow, please?
Yeah, you bet. So Grow is a SaaS company that we built the easiest way for companies to connect all their different data, pull it into a central place, and have real-time insight into what's happening in the business. So we do that by having over 150 different data sources and native integrations that you can connect easily with Grow and pull that data in and build these real-time insights. So some quick stats on Grow. We've got about 1,000 customers. Our largest segment of customers are SaaS companies. Some of the fastest growing SaaS companies at that. We're tracking about 140,000 metrics or KPIs for companies. So I think that puts us and uniquely qualifies us to have this discussion. So delighted to be here.
Yeah, excellent. And so just before we jump into the meat of the webinar, I wanted to highlight some of the overall format. We'll be taking a look at 6 specific metrics that are important to every SaaS company. Many of you will have heard and used these metrics in running your business, but today you will get to hear the perspective from BJ as that of an investor, followed by Rob's perspective as a SaaS CEO and one whose company deals with these on a daily basis. So between these two, we hope you will learn something relevant and insightful for you to take forward with you as you grow your own business. So without further ado, we want to look at the first metric we're going to be looking at is committed monthly recurring revenue.
Yeah, this is BJ. So I'll be talking about each one of the metrics, kind of giving you a definition. Then Rob's got some awesome data to walk everybody through to give you an idea of like how it really works. Because when you sit down to crunch the numbers and get this data together, it's not always an easy thing to do. So seeing it actually go into action. So thanks to Rob for getting all that stuff together. I feel like I get the easy part here. So looking at this first slide, committed monthly recurring revenue, CMRR. First just making sure everybody kind of level sets with what MRR is, monthly recurring revenue. And looking at CMRR is a little bit more specified than that. We've got the equation here to look at, but let me walk through it to make sure it's sort of clear. So basically, whatever you got for new business, or business you got, plus any expansion, that means any upsells you've got. Let's say you've got an enterprise customer and they keep on adding seats as they more fully implement the offering that you have inside their organization. Minus any loss, obviously any contraction in those agreements, minus the churn, meaning true loss of customers entirely. And then you're going to add on that signed contracts. So you've got all the full committed amount in all of that equation and such, which really tells you kind of like what your expected run rate is and what you're committed to doing. So you can really plan out your business pretty well with that. And in some ways, somewhat unique to SaaS or any sort of subscription-based recurring revenue stream, the ability to predict out some of these metrics is really relatively unique, right? You sort of compare it to old line businesses like a dry cleaner or something. It's hard to predict out how many people are going to bring in their shirts to wash every day. But with a lot of these SaaS metrics, you can really plan this stuff out, and CMRR is a great one for really knowing as far ahead where you have committed revenue coming in.
Okay. And so we could maybe look at it from Rob's perspective. What do you see from CMRR?
Yeah, so BJ, I like how you put this metric as number one. I mean, revenue is that trumps everything. It's the most important thing in a startup, and so I'm glad we're talking about this first. I mean, obviously, where we pull this is usually, from a billing application. At Grow, we use Zora. We used to use Recurly, and so we're pulling that and calculating the MRR. The MRR is what the whole company rallies behind here. It's the metric that we have in the top left corner of our dashboards. Everybody kind of rallies behind that here. And so I've got an example here. This is a chart that we use. Now this is a little bit different than true MRR. This is kind of a meteor metric that I've kind of moved over to kind of obsessing about here inside our company. So this takes the new MRR added that month, less any cancellations or churn, revenue, to give me just the net new. So internally, I'm focused on this. The rest of the company, we all kind of rally behind the MRR goal that we talk about, that we share and have goals every week to grow that, which I think is important. Now, this metric also gives us some insight around what our burn rate should be, and this is what I like about it. I mean, the burn rate's usually more art than science, and but this is kind of made a little more concrete. So what we try and shoot for is to match the new ARR added to the amount of burn that we have at a rate that's 1-to-1, if that makes sense. So if we had 10 million in new ARR during a year, and if we burn $10 million to get that, then we feel great about it. And so that helps us kind of unlock some of the secrets of what burn should be, which I think every entrepreneur kind of struggles behind. And you know, the committed MRR gives you really a pipeline. So I've got another snapshot of how we look at pipeline, which is really our sales funnel. The committed is typically relevant when you're in the enterprise space and you're dealing with enterprise contracts that, you know, you've got the contract that you haven't built for yet. At Grow, we've got an 8-day sales cycle, so it's a very short sales cycle. So I look at the overall sales funnel, and this is one of the metrics that I look at to do that. Now, here's my big disclaimer. I mean, we've got some sample charts in here. This is charts that we look at internally for Grow that we share with our investors, and obviously the data is not Grow's data. We've kind of had some help in kind of randomizing some of the data, so it's different. So don't hold me accountable to these numbers, but these are you know, the actual charts and views of how we look at the data. So I'm looking at like total leads to demos set, demos given, opportunities created, and deals closed on a week-over-week period. If you're enterprise, that might be month-over-month or quarter-over-quarter, but with our short sales cycle, it's week-over-week. And that's how we look at it. You know, one of the questions that I had in raising a Series A that, you know, is common for investors to ask is, okay, how much are you spending in money in marketing now? And at the time, pre-Series A, we were spending, I don't know, $15K a month in marketing or ad spend. And the question I had was, okay, what happens if you triple that spend? Will that influence, you know, will your leads proportionally go up to that? And so what I did is I said, look, if you feel comfortable, like if this makes you feel more uncomfortable, why don't I increase ad spend for 2 weeks, and I'll send you, you know, what our lead count is doing. So I did that and just took a snapshot of our leads like skyrocketing for the next 2 weeks, and that I think helped close the deal with this investor on our Series A. That like, hey, if I put money into the engine, here's the result that I'm going to get out on the other end.
A couple of things, this is BJ, a couple of things I love about what Rob said there. Number one, it's a really great point that, you know, your sales cycle and the average sort of sales price that you have for your offering, things like that are really going to make a huge difference in which metrics you use, like whether CMRR is going to make sense. And Rob's exactly right. Like it makes much more sense for like an enterprise type sale where your average customer is going to be, you know, tens of thousands of dollars. I also love, Rob, your example of traction. So for investors in general, you know, they're all sort of momentum players that are looking for traction, right? So if you can show, as Rob did, that you can push on one lever and really show the difference in lead growth or anything like that, that's like crack to an investor. That's a great example.
Yeah, and I think for the entrepreneur, it's this balance of, you know, do I burn more to get more? And I think that ratio has helped me answer that question. You know, overall, traction is more important than burn, I think.
Yep.
You get a lot more investor attention if the traction's there.
Yep.
So.
No, absolutely. To the point, sometimes it gets a little bit overwrought where you get things that, you know, don't have unit economics that work. But in general, absolutely.
Yep.
No, that's great stuff. So the next metric we have here is the CAC payback. So CAC for everybody is customer acquisition cost, which is somewhat right what Rob was just sort of alluding to with you know, the lead flow and spend on leads and such. But when you go calculate your CAC, you're going to go and shove in everything that's related to going and acquiring a new customer. And it can get very different with different kinds of companies and such, but you want to be realistic about what are really the marginal costs of going and getting that customer and such. The CAC payback period then is really looking at how long, and it's generally expressed in months, although kind of like we were talking about a minute ago, depending upon your business, it could be weeks or something like that. But generally speaking, maybe expressed in months, and it's how many months you have to retain that customer to have them pay off the customer acquisition costs. So give you a hard example. Let's say it costs you $100 to acquire a customer. And that would be for a smaller type offering. If you have an enterprise offering, it might be $30,000 to acquire a customer. The key really for investors and for looking at sort of the unit economics of an offering is, can you get a payback on that? Can you pay off that customer acquisition cost? So in the first example, $100, if you can pay that off in almost either situation, generally speaking, for an enterprise type sale, if you can pay it off in less than a year, you're looking pretty good. But that's assuming you're going to keep the customer for multiple years. So that's why we put in the bottom here, so that the customer acquisition cost and the lifetime value of the customer, we'll get to lifetime value later. But the relationship between those two can be pretty important at looking at your ability to drive the economics of the business over the long term.
Yeah, we put a lot of emphasis behind this metric, and I'll kind of walk you through exactly how we measure and just a really easy way to kind of calculate this on an ongoing basis. So, the data where we pull this is from Salesforce and QuickBooks, and what we do is, I make sure that our P&L and QuickBooks, or if you use Xero, same thing. Make sure our P&L has got a sales and marketing category to it with subcategories. And then any payroll company will have departments, and so you can tag an employee, hey, their sales or marketing costs related, and pull out payroll and benefits and payroll taxes so that you can segment that on your P&L. So inside Grow, we make a call to QuickBooks. We tag the line items on our P&L month over month with just the sales and marketing costs. So, sales commissions, payroll, advertising, any of that. And then we make a call to Salesforce that pulls number of new customers month over month. And I just do a quick calculation inside Grow that gives me this chart, which shows, our acquisition costs month over month. Now, one of the important things that we did was that we looked at, what's our CAC when the customer comes in that everybody calculates, right? And then what's the adjusted CAC after churn? And we make sure that, like, if a customer churns in 6 months, that we go back and it automatically updates this adjusted CAC. And here's what I really like about this metric is that it helps tell the churn story. And we're going to talk about churn in a minute, but if I look at, like, what's our adjusted CAC after churn, and when is that payback period? And that's something I watch closely, and that we talk with our investors about. So, in this example, the adjusted CAC is, paid back within 10 months, which is still really, really solid. And I hope that makes sense. And so those are the two things that I think are important to measure CAC, that the adjusted and the gross when the customer gets acquired, and that's how we calculate that. So a couple of leading indicators that we use in helping us look at CAC, which is really kind of a cost per lead and a cost per sale. Those two things, cost per lead and cost per sale by channel, that we're advertising or putting focus on, so that we can measure those and see what's effective and help drive that CAC, that core unit economic metric, in the direction it needs to go.
Yeah, that's great stuff. And like you said, CAC is just sort of the ever important thing. I think it's probably a good lead into our next topic too, as Rob, as you're saying, on churn and such here. So we've broken out two different kinds of churn to talk about. One is customer churn, and then after this we'll talk about sort of MRR churn. Other ways people talk about it, customer churn often calls kind of logo churn. Basically, it's the customer count that you're looking at. And really, you're just looking at are the number of customers you retained over a period of time. So let's say on January 1 of 2017, you had 100 customers, and at the end of the year, you had 50 customers. Well, you'd have 50% churn by logo churn or customer count. Some of the interesting things that we look at here from an investor perspective is really, how does churn relate to what the offering is? If it's a consumer offering, 50% churn might be really low, actually. If it's more of like an offering to small, medium-sized business, SMBs and such, 50% still, that's a little bit high, but it might not be too high depending upon your customer acquisition costs and things like that. Generally speaking, with the enterprise, you see the lowest kind of churn rates, and we often see companies that are like on the Salesforce platform or things like that that have got a churn that's significantly less than 10%, sometimes less than 5%. A lot of times those companies, if they're systems of record, like a CRM system or something like that, they'll have incredibly low churn rates. Primarily, they're losing customers only when those customers go out of business or get acquired.
Yeah, I mean, and I'll, and I could, so I'll talk through, how we look at churn and how we measure it as well. I mean, churn can be as easy as number of customers that start a month, number of new end of month customers, less any new customers added in the calculation around that. That's kind of on the simple side, and then you get into like really complex churn models and how to calculate churn. So we look at churn in kind of one chart. So our main churn chart looks similar to this. You can go to this this chart that measures logo churn and dollar churn on the same chart that's kind of overlaid. So let me just touch on this customer churn. For our own purposes, we see churn in two different areas. One is acquisition. One is by acquisition, and the other one is by behavioral churn. And so the product team takes behavioral churn and looks at like what customers do inside the app that's causing them to churn, or what are they not doing inside the app that's causing them to churn. And this cohort's kind of like a graduating class, right? So every customer that's signed up that goes through this flow, how do they churn out? And same way on the acquisition side. Every customer that signed up like in July 2016, if I'm looking at that data, how many stayed with us by the July 2017? I prefer to look at it on a cohort basis, and I'll tell you why. I mean, month to month is you see a lot of people looking at it month to month, and that's great if you don't have any contract terms. Once you have like a 12-month agreement or something like that, it makes most sense to look at it on a cohort level. And I've seen companies say, hey, our churn on a month-to-month basis is 1.5%, and then once you look at like a full cohort, the cohort's down to like 60% or something like that. So that's why I think it makes more sense to look at it on an annual cohort if you have contracts. Now, another angle or another view to look at on this customer retention is this next chart, which really shows, really kind of shows, the churn by day or the retention by day. So like January 1, you had 896 subscribers come in, 100% stayed with you that first day. Now day one, you're down to 24%. And so you're kind of looking at it, whether it's daily or monthly on a view like this. This is how we kind of, we bake in our churn models on the financial forecast. It's something a little more granular like this, but on our own dashboards and what we share with investors, it's more of that monthly cohort. One more thing too to consider is that there's a lot that goes behind churn, right? I mean, we have a full dashboard of our churn metrics with like, I don't know, maybe a dozen or 15 metrics just around churn. So we're looking at like, what is our churn by industry? What's our churn by customers with certain employee sizes? What's our churn by sales rep? What's our churn by our CSM rep? All of those things kind of help tell the story so that that you go to work on this. This is like the #1 killer for all SaaS companies, right?
No, absolutely, absolutely. It's churn is a fascinating thing. It's a simple concept, but exactly as Rob points out, when you dig into it, it really obviously depends a lot on your business. Again, sort of the average sales price that you're offering, who your target market is, and so like that. It becomes a many-hued sort of beast of diving into things, especially like Rob, you're saying, if you can nail it down by like type of end customer or size of end customer and so like that. We see a lot of the best companies that we see in terms of long-term performance are really good at narrowing in on churn rates and on who is churning off fast and how to either switch the offering, adjust the offering, or adjust their marketing to start going after segments that don't churn nearly as quickly. I'd say one interesting thing too from the investor's perspective, we at Lighter here, we fund some B2C companies, but predominantly we fund B2B companies, and we're pretty good at looking at B2B companies and understanding churn and how churn will typically go down over time. So your retention rate for the customer will go up over time as your offering gets better, as you get better at narrowing down how people are really going to use it, or like Rob pointed out, the product team like really looking at where people are engaging with it. You can look at those kinds of activities and really try to reduce down churn. One thing that's interesting that some friends of mine who invest more in B2C type subscription businesses is they will often see, especially as companies get larger and larger, a lot of the B2C offerings, the churn rates will actually go up with subsequent cohorts, which is very opposite than we typically see. One, for example, was on a panel with recently, was talking about Dollar Shave Club. They were an investor in Dollar Shave Club, and Dollar Shave Club had actually seen cohorts later on have lower retention rates. And the thinking they had behind it was kind of interesting. And obviously it's different than a SaaS business, but I think it's an interesting illustrative point. The thinking behind it was that basically the original or earlier people that subscribed were really the diehards, and then after a period of time, the new customers were a little bit more marginal, and so were more willing to churn off or turned off more easily. So anyway, point being, you really have to adjust it to look for your business and see how it works. Next stat here is MRR churn, or dollar churn, as Rob and I both called it. And this is really getting to the heart of things. We love to look more and more at dollar churn if we can, just because it really is what drives obviously the cash flow of the business and things like that. Also, we find a lot of times as companies go up market slowly with their offerings, they will start having an offering that is sold to small businesses, and they'll slowly climb up over time to having more and more enterprise businesses. So they may lose a lot, or they may have decently high churn on a logo basis, but relatively low churn or negative churn on an MRR basis, on a dollar basis, because they're doing a lot of upsells, which gets them the negative churn. So this is one we really try and look at hard. It's very difficult sometimes to actually nail down exactly because sometimes the companies don't have the data. In fact, I guess that's a good plug for Grow, really, is to have all that data and mash it together. But if you can actually get down to the dollar churn with real good precision and break it down into different cohorts, you can really sort of mine a lot of gold there.
Yeah,
Go ahead, Rob.
You talked about negative churn, negative dollar churn, or net negative churn. I mean, that's the holy grail for all SaaS companies, right? I mean, it's equivalent to same-store sales, right? So a customer comes in and they start out at $1,000 a month, and then they upgrade to $2,000 a month, and in 12 months they're paying $3,000 a month, and that additional $2K MRR offsets any churn customers. That's what we're talking about by net negative churn. So, again, the chart that we use comes back to measuring dollar churn and logo churn, and you can see that, where it's over 100%. On this example, you've got that net negative churn. Another example is this chart where, if you could go to there we go. So here's another way to look at it, which is, MRR at the start of period, active MRR, and MRR fallout to come up with that calculation. And again, I mean, the financial models that you create will have something a little more sophisticated that, has assumptions built in, and you can mine that. So I think the whole key is like a solid, pricing and upsell strategy. So for Grow, for example, we don't charge based on users. I mean, that's the common price point and price break in SaaS is, kind of user-based pricing, and it just kind of is counter to our core belief of like democratizing data and giving people access to this, and having the whole organization, give them the ability to build their own reports and insights and share those insights. So it's more of a usage base. So those are kind of the two models, and so it's having some kind of good upsell strategy, and then you've got to tell the story behind kind of each cohort, like BJ talked about. I mean, if a customer comes in that's smaller, their churn may be different than a larger enterprise customer, and if you run the gamut of customer types and segments, that you can tell the story behind each cohort and the churn numbers behind that.
Yeah, no, that's a great point. It's super interesting to look at like the different sort of net negative churn possibilities that companies have. Like I think both of us are hitting on this hard, which is it is a bit the holy grail. We do see that a lot of times, particularly in the enterprise, where people are selling to enterprise. It seems like the larger customers you get, that's much more possible. And that's interesting, Rob. You point out that you guys don't do per seat charges. And by transactions, it seems like this is a whole different topic of sort of pricing theories and methodology in SaaS. It's a whole different kind of thing, but it will affect your churn, I suspect. But we're actually starting to see more and more companies pricing their offerings kind of like you guys are, and it seems to be pretty effective so that they get broad adoption inside a business, but then they also get the effectively net negative churn through increased usage. So that's interesting. That's what you guys do as well.
That's right, yeah.
That's actually a pretty good segue into sort of customer lifetime value. So this one, just to start off, this one is for all businesses that are startups. This one, especially ones that are going to have customers that last for a long period of time, and the deeper you are, like a system of record, and the more you're selling to enterprises, where it's going to take them, a sales cycle of 9 to 18 months to buy it, and that means it's going to take them, several years to get rid of it, most likely. It can be really difficult to accurately assess and have true data around what the lifetime value of your customer is. A lot of us have spent years, especially the early years at a startup, having to just basically estimate what the lifetime of a customer will be, because you know what you're getting paid for a particular period of time, like a year. You just don't know how many years they're going to truly stay with you. We internally look a lot at how sticky revenue streams are and churn rates and such to try and estimate this, but as we've been talking about, churn rates can alter a lot over time, and it depends on which churn rates you're looking at and things like that. Obviously, if you've got true net negative churn going on forever, does that mean you effectively have a lifetime value that's monstrous? It can be very, very difficult to do this. That being said, even though it's difficult, it's really important in terms of raising money to have investors be able to understand what you're really looking at or what the expectations are. And even if you don't have perfect data, if you can make a good argument through your churn analysis or things like that of why you think that the lifetime value of your customer is 3 years or something like that, how long they're going to go, times what your average revenue per customer is going to be, that is really important to be able to make those arguments and make them in a sound way. Obviously, with investors, you want to be a bit bullish, but you still need to be credible and sound with those arguments, because the lifetime value is really when they're breaking down what your unit economics are going to be is sort of the underbedding of that entire piece. They're going to look at your customer acquisition cost, the payback period, all that stuff, and then making an estimate of the lifetime value is huge. Earlier on, we were talking about having a CAC payback period of less than a year for a lot of enterprise type offerings, and Rob was mentioning for Grow it's like 10 months. That's great. If you're an enterprise type offering that's going to have the customer for much more than a year, if you're only going to retain the customer for 6 months, obviously it doesn't really economically make much sense, and you're going to have to work on reducing that churn and sort of improving the value of your offering pretty extensively. So it's a difficult one to get, but it is also like incredibly important when you really assess the overall business.
Yeah, and it is difficult to get. I mean, we had a guy work for us that did all of the paid advertising for Zappos and American Eagle, and he said that they had a whole department of on the analytics team do a deep dive for 6 months to figure out what their LTV was, and they finally just walked away and said, we can't figure it out. And that's probably a little bit harder. Our best estimate, unless you've gone through kind of a full cycle and have several years of history to kind of do a better analysis, is really based on churn, right? So if you got like a 2% churn per month, you're churning out 24% of your customer base a year. Essentially it's 4 years. I mean, less than 4 years, because that 2% erodes every month. So you're 3 years and change. But it's to try and get your best estimate, and then the calculation that we also look to with LTV is like, what's the CAC to LTV ratio? And I think investors, correct me if I'm wrong, BJ, but you guys look for at least a 3-to-1 LTV to CAC ratio.
Yeah. I mean, that's healthy for sure. It does get interesting when you start making some of the assumptions around. I mean, number one, you got to make some assumptions around LTV, just like we're both talking about. But then also a lot of times when a company is particularly earlier stage, number one, the assumptions are built off of less solid data just by the very existence of it being short term. But also you're going to assume that they're, especially in the enterprise space, you're going to assume that they're going to improve somewhat over time as the company builds out their offering more, it becomes more valuable, they're able to upsell it and such. And so depending upon the stage, you can see big differences in what people think is reasonable for that ratio. But 3-to-1 is always like reasonably safe, I think. If you can build it and have 3-to-1 at an earlier stage, I think you're looking pretty good, because if anything, it should get longer or better over time.
Yeah.
That's the.
I put this in there. I mean, this is as you look at churn and kind of figure out the LTV. I mean, this kind of shows that the first year of customer churn is you take the deepest, it has the deepest dive, right? So that churn percentage that is going to be a lot different year one than it will be year 2 or year 3 or 4. And so my point in how we look at it on our modeling to calculate LTV is, hey, what's year 1 churn estimation? What's year 2 churn estimation, and year 3, which all calculates into that LTV.
Yep. No, it's good. It's good. Good point. All right. Average revenue per customer is our next one. Sometimes also average revenue per unit. It's called ARPU. It's really how much you're making off the customer in a given period of time. We often look at it as annual, but depending upon the offering and how long you're going to retain the customers, you want to look at it per month as well. It's over a given period of time. And really for us, we'd love to break this down and look at different cohorts on it, either by segment or by end user type. A lot of times, for enterprise, you're going to have obviously a very, very different kind of average sale than you're going to have for SMBs and things like that. So it depends a little bit on what the company's offering is as we'll go in and look at this. But looking at the average revenue is going to drive a lot of your different kinds of activities. Obviously, if you've got a small amount of money you're making off the customers each year, you got to retain them for a long period of time, and those tend to be a little bit sort of negatively correlated in terms of the average cost amount of retention sometimes. And it drives, of course, also at what your CAC is going to be and such. Love to hear what Rob has to say. So go ahead.
Yeah, and we've got a sample screenshot of how we look at this average revenue per account. And this is just a sample, but the idea is, hey, this is trending upwards. Some leading indicators for us and some interesting examples is that we really watch the conversion rate from our opportunities to closed won deals, and that determines it a lot, right? So if we have the ability to increase pricing, as long as that opportunities conversion to closed won rate doesn't significantly drop. So that's how we've really kind of played around. We're probably on our 25th pricing iteration at Grow. And several months ago, we did a big push for annual payments. Like, hey, we're only going to do annual payments with customers. And sales significantly slowed, right? But it slowed more than the value that we received from that. So we went back and said, hey, we're better off selling on larger deals if we gave better terms to the customers, meaning they could pay monthly if our deal size increased. And so the key to making that work, right, is like, hey, do we have enough cash in the bank to kind of support that model and to make it work? And I think that's what we've ended up at Grow, and that's really kind of my last pitch to kind of bring this back to BJ and raising capital, is that works when you can raise capital. It's been the right thing for us, right, is increasing our average deal size because we can be more favorable on letting customers pay monthly versus just annual payments. And so it's really kind of played into our favor, and raising capital has made this whole thing work for us.
Yeah, no, it's interesting. Obviously, and a lot of times with SaaS, right, the development costs, the saying goes, development costs in SaaS have gone down over developing software in prior periods, but the customer acquisition and sort of product market fit a lot of times has gone up for a lot of these companies. But that is really interesting. One thing that we find a lot of times is the average revenue per customer, or ARPU, will go up as companies continue to go up market, which is natural, and we'll often see it positively correlated with reductions in churn, which all stands to reason, but we really do across the SaaS companies we've funded see that pretty consistently. So sometimes when we have a hard time getting really solid churn data, we'll actually use ARPU, as we call it internally here, average revenue per unit, as a bit of a proxy for it. It's a very, very crappy proxy. It can actually be going contraindicated with sometimes, but as long as you understand the story of the business, sometimes average revenue per customer will give you a lot of insight on it. For some other companies, it really doesn't. So it's interesting, Rob, that for you guys, it was really something you focused on, as well as all the churn analysis you guys do.
Yeah.
All right. Well, I think that brings the end to the formal presentation section. So a huge thanks to both Rob and BJ for highlighting kind of their perspectives on some of these key SaaS metrics. We do now have some time available for those able to stick around for questions and answers. And so first question, we have a number of them that have come in. One question first, it says, how do metrics a startup uses differ from metrics a non-startup use? Is there a difference? Maybe BJ, you could take a stab at that?
Yeah, I mean, some of them can be very much the same. I think in general, once a company gets a little bit more mature, they're going to settle on certain metrics that are really telling for them, and depends on how much change they're going through. I think a lot of the metrics we're talking about here can be pretty universal, but the way you're going to go about looking at them and how you might break down the data might alter a little bit as you grow. I feel like with a lot of startups, a lot of us are really searching for product market fit and trying to make sure we're really hitting the markets the way we want, and that tends to be a little more of a hyperactive testing mode, whereas larger businesses, that whole cycle tends to slow down a little bit, just partly because of bureaucracy, partly because they've obviously nailed it to a certain extent in terms of finding that product market fit and such.
Mm-hmm. And the next question we have, sorry, Rob, do you have something to add to that?
Yeah. I was just going to say, I mean, yeah, in that product market fit phase, I mean, number one metric is, don't run out of cash.
Yeah.
Right? I mean, the only worse than being diluted is, running out of cash. So that's like the top metric.
Yeah. Yeah.
Sounds reasonable. Next question is, should MRR be computed from contract start dates or contract execution dates? Sometimes both will be in different periods.
Yeah, we really want to see the contracts executed mostly. I mean, we really look at, when we're funding a company, and this in particular to Lighter Capital, the committed MRR, we really want to see the revenue actually start to be recognized and come in and such. But we will also look at when the contracts are signed and such. It's really the most important thing is that you've got a contract signed with a good counterparty, number one, right? The key thing really is the underlying actual business outcome. But really we look for the contract sign date, not the actual commencement date necessarily.
And I guess the next question is, what's the benchmark monthly churn rate from a customer churn and MRR perspective?
This one's
Yeah, go ahead.
This one's probably challenging. Yeah, this is Rob. I mean,
Yeah.
you know, we're in the SMB space, right? I mean, and I've done, you know, I've done a bunch of research on like what's standard, you know, churn in SMB. You know, and it's I found a range between 35 and 50% annual churn in SMB, which is huge. So, you know, if you're in that space, you need to be in a large enough market where, you know, the customers that are with you after 2 or 3 years, it's a large enough market that you can build something substantial, or you dramatically change that. You know, and then coming back to like CAC also helps tell the churn story, right? If your CAC is low enough, the churn may not matter as much, and the model still really works.
Yeah, I totally agree with all that. And we find very much the same thing for selling to SMBs. And let's be clear, like when we think of SMBs, we're thinking of truly small businesses, not like the way Wall Street would assign it. You know, Wall Street would say anybody with less than like a 2 billion market cap is like small or micro cap or something like that. We're talking about truly small businesses when we think about it, like companies that are doing, you know, a couple $1 million in revenue or less, or maybe have like, you know, less than 50 employees or something like that. And we see exactly the same thing. So if we see a company that has like an SMB offering and they've got a churn rate of 35% or less, we consider that pretty strong, really good. And we often see, like Rob was saying, you know, 50% or so. If you get much above that, it starts to be a little bit concerning, and you end up diving into really like heavily, why would that be happening? And what we tend to see is if the average sales price or the average revenue per customer is pretty low, sometimes the churn rate will be a little bit higher. In other words, the company is probably offering something that's not going to be deeply embedded and deeply valuable to the business, and they're not charging that much for it. And so a lot of times their end users tend to kind of turn it on, turn it off. Getting back to the question too, a little bit beyond just SMB, because it really does a sliding scale. We found if you're selling to enterprises, a lot of times we'll see churn rates that are less than 25%. In fact, with enterprise sales, anything more than 25% makes you again dig in and say, okay, why is it that it's that high? We often see churn rates that are less than 10%. And again, we're talking about churn rates as a gross thing here. If you're looking at dollar churn rates, things like that, this can change quite a bit. So these are sort of very rough benchmarks. And then on the consumer side, a lot of churn rates that are in excess of 50%. So breaking it down, you know, might have enterprise churn rates of significantly less than 25%, SMB somewhere in the like 30 to 50-ish, and then B2C, depending upon the size of offering and stuff like that, typically we'll see something between like 40 and 80% churn rates.
And I guess a couple of people are inquiring whether or not the presentation will be available afterwards, and it certainly will be. So we will plan to follow up with both a copy of the slides themselves as well as a copy of this recording. So if there's anything that you want to dig through afterwards, you certainly have that available. And here we have a question from Nicole. It says, what would you suggest would you suggest the same major metrics for a SaaS company looking for a second investment round?
I think, yeah, I mean, speaking as the sort of investor here, I think, yeah, a lot of, kind of similar to the question earlier on does this change over time? You know, the metrics you're going to look at and how you're going to look at them is going to change a bit over time. But as you go from to a second investment round, so in other words, going from a Series A to a Series B, a lot of these same metrics are going to be absolutely core to your pitch to investors, and they're going to want to see that between that Series A and that Series B that you've probably made some material progress in improving those metrics, a lot of them, because really, especially with the Series B, this is very sort of stereotypical, but with Series B, they're really looking for you to expand your offering. They've expected that you've got some product market fit that's going really well, therefore all these metrics should be moving in the right direction, and they're really pouring gas on the fire with that Series B.
And here Scott asks, are these metrics also good for young business at 1.2 million ARR?
Wait, sorry.
Just looking, I mean, is the profile of these business or metrics kind of applicable to companies of that, say 1 to 2 million in revenue range?
Yeah, I think so. Obviously, the depth of your ability to analyze all this data will depend upon a couple things. One is, have you actually collected the data in a way that you can rely upon it? Having clean data is super important in all of this, and it's amazing how many companies really don't. And then, do you have the resources available to spend the time to analyze it? And just to this is BJ talking, but I'll give a nice plug for Grow. A tool like Grow will monstrously help you be able to handle all of this and be able to get some good insights on what you're looking at in terms of these this data and such. So a company doing 1 to 2 million ARR, absolutely, an investor is going to expect that you've got good answers for a lot of this data, and in fact, they're probably going to expect you to have a lot of that cohort analysis, like Rob was showing, a lot of that stuff done, so that you can really see, within just the headline numbers, like, hey, I've got negative churn. Well, okay, that's great. Can you really break that down for me into different cohorts and such? Rob, you probably have great insights on.
Yeah, from my perspective, I mean that's 1 to 2 million ARR is like Series A stage.
Yep.
And that's when the expectation is that you understand the metrics, and the metrics are going up and to the right. I kind of feel like at a seed round, when you go to do that, you can raise a seed round based on the story and your reputation. But that A round is when they need to see the data and those charts up and to the right.
Yeah, I totally agree with that difference between seed and A. A lot of times with a lot of seed rounds, you see people want to see some sort of traction, but it doesn't end up being solid metrics around a lot of this stuff. It's some leading indicators. It might be that you've got a decent amount of initial uptick in user adoption, or maybe if you've got an old freemium model going or something like that, you've got people using it or something like that. They want to see some sort of up into the right traction, but it tends to be pretty limited. Whereas by Series A, exactly as Rob said, you better have some pretty solid numbers around this. And if you're at 1 to 2 million in ARR, you've probably been studying this data for quite some time, and have some decent analysis around it.
A very interesting question. So we have for a SaaS company not using a subscription model, but instead is using an on-demand model. What do you suggest is a good equivalent to MRR or CMRR?
I'm an on-demand model.
Right. And
Go ahead, Rob.
I'm not sure I understand. I'm not sure I understand that.
Maybe having a usage model as opposed to having a subscription model. So
yeah.
So maybe you guys have that model. So maybe Rob, you can go out and I can add on.
Yeah. I mean, it's interesting. I mean, if it's an on-demand model, I mean, it sounds like it's just kind of transactional based. I think the key to SaaS and what makes it great is is this reoccurring revenue, and so anything that it doesn't have that. I mean, if there's a way to kind of convert it to reoccurring revenue, I mean, I think that's where you get the multiples. That's where you get a lot of the scaling effect versus transactional. When it's not, if it is transactional, if it's not reoccurring, what's equivalent to MRR? I don't think I could tell you.
Yeah, I agree. We funded.
Revenue.
Sorry, go ahead. Yeah. Yeah, it's interesting. We've funded a decent amount of companies that they're SaaS, I mean they're a cloud-based offering and stuff like that, but they are more transactionally based. And when we've looked at those companies, a lot of times obviously the sales price tends to be pretty low. Not necessarily a consumer offering, but they always tend to be pretty low. Obviously, you're not going to go and turn on and turn off like a $100,000 type offering and such. So what you end up doing a lot of times is looking at, and we've seen either amount of repeat customers, and then you don't end up with the exact same data on churn and things like that, but you end up with like repeat customers and how long between repeats and some things like that that give you an idea of like how much are people coming back. It's much harder to benchmark a lot of times these kinds of things, but that's certainly one way we've kind of looked at it. And not entirely shoehorned that data into these kind of SaaS metrics and such, the sort of subscription type metrics, but you can get things that give you more predictability about how that business might operate over time. Especially because you can still look at CAC and the sort of whether the unit economics and stuff still work. You can still look at a lot of those things, but it is much harder with a transactionally based model.
Mm-hmm. And Rob, is there anything else, or do we think we got to cover that one?
Yeah, I mean, my last thought on that is, my last company was more transactional based, but there was enough consistency in the transactions that we could model it out and really kind of nail and be accurate on the model. So a lot of the same metrics still apply.
Yep.
Got it. Well, I think that brings us to the end of our allotted time, so I want to say a huge thanks to Rob and BJ for providing us with a lot of valuable content and some great perspective on how we can help you hopefully grow your businesses. So if you have any interest in contacting Grow to learn more about their business intelligence dashboard and the awesome tools that they have created, he sees contact information for Joe Durfee, who's the VP of Partnerships. And at the Lighter Capital side, please don't hesitate to reach out to me if you're interested in learning about non-dilutive growth capital available from Lighter Capital. So with that, certainly wish everyone a wonderful day, and we'd love to keep in touch with you on an ongoing basis. So thank you all very much.
Thanks, everyone.
Thanks. Thank you.